So pull up the AMFI data for mutual fund flows. We'll see that all the way from March, we saw flows tapering off because investors got scared after that market fall. And it was only in March of this year that money started coming in. All the way from July of last year to Feb of this year, there were consistent outflows. And then it was only in March when the market was, in July when the market was already at record highs that we saw retail investors pumping in money. And this behavior is in stark contrast to what savvy investors have been doing. So if we pull up the data that we have collected for banks, subsidiaries, even national distributors, you will see that already by March these investors were overweight equities, or rather they were following their allocation. So almost 50-60% in equities across the board. So there are lessons that retail investors can learn from how savvy investors are managing their money, and the answer lies in staying true to your asset allocation. Kirtan Shah of SRE Wealth joins in now to talk about exactly this. Kirtan, thanks very much for joining in. So we want to take this time to help retail investors get rid of their behavioral bias. One is, how can they get their asset allocation right?
Sumaira, thank you so much for having me on the show. Sumaira, like you rightly pointed out, I think there's too much of behavioral bias that comes in while we as investors and specifically retail try and time the market. I think the best way to move forward in any given market situation is to have the right asset allocation in place. Now, typically to get the right asset allocation strategy, Sumaira, the first thing which is most important is for us to be able to figure out whether what is our risk profile. Are we conservative, moderate, or aggressive investors? Now, if you want to follow a methodology, now there are a lot of risk profilers available on the internet that any of our retail investor friends can go and check. You answer a couple of questions and you understand whether you're a conservative, moderate, or an aggressive investor. Now, what that typically does is that, let's say if you identify yourself as a conservative investor, what asset allocation typically tells you is that have certain portion of your money in equity, some in debt, and some in gold. So let's say a benchmark that we follow is, let's say if you're a conservative investor, have 20% in equity, 75% in debt, and 5% in gold. And similarly, if you are an aggressive investor, have 80% in equity, 15% in debt, and 5% in gold. Now, typically, most of this is available on the internet. What I really want to talk about, which I believe that a lot of us don't do, is further bifurcating this asset allocation into a bucket strategy. Now, what's a bucket strategy? So let's say, for example, if I'm an aggressive investor, where I believe that 80% of my money should be in equity, 15% should be in debt, and 5% should be in gold. Now, I would further bifurcate this into three different buckets: liquidity, core, and satellite. Now, let me first explain to you what these means before we move on to an actual asset allocation. When I say liquidity bucket, I'm specifically talking about that amount of my money. Sorry, Sumaira, I think you were saying something.
Go ahead, Kirtan.
Sure. So while I talk about liquidity, I'm saying I'm actually looking at that amount of my money which I should have access to whenever I want that immediately. Core is the bucket in which most of my investments will happen depending on what my risk profile is. So if I'm an aggressive investor, this core portfolio will have aggressive investments. And then the satellite portfolio will typically be investments outside of my core risk profiling strategy. That is where I will be taking slightly more risk than my core portfolio, where I'll be able to generate alpha, right? So if we look at the asset allocation strategy, we can further break that down into liquid, core, and satellite portfolios.
Understood. So let's start with, how does an investor with an aggressive profile decide his allocation?
So Sumaira, let's say if you're an aggressive investor with, let's say 80% equity, 15% debt, and 5% gold as a standard allocation that you want to do, what you typically do is further break that down. So let's say the debt allocation that I have for 15%, I will further break that down as 10%, which will be in my liquidity portfolio, which can be arbitrage funds. And the remaining 5% of the debt allocation that I need to do can be in my satellite portfolio, where I'm taking slightly more risk to generate that alpha. So 5% of the debt component can be invested in, let's say, a credit risk fund or a gilt fund. Now, that's how you bifurcate the 15% of your debt allocation as an aggressive investor. Let's say if you have to do 80% allocation to equity. Now, what you do is you put 70% of your money in your core basket, which is either you do large cap, mid cap, flexi cap, mid cap, small cap kind of category investing. And then you can keep 10% of your money in the satellite portfolio aside, where you can either opt for international, thematic, or sector funds, depending on what you're trying to do with your portfolio. And then you can have the remaining 5% of your gold allocation, which is largely a satellite portfolio in case of an aggressive investor. So that's how, in my opinion, you should break down the 80, 15, 5 general asset allocation into 3 buckets, Sumera.
Got it. Okay, so what about a moderate risk profile?
So, Sumera, what happens in a moderate risk profile is something very similar. So what I would do is, because I am a moderate investor and I want to do 45% in debt allocation. Now, how do I split that? I keep the 10% in the liquidity portfolio, which probably might go to an arbitrage fund or a liquid fund. The remaining 35%, which actually becomes a part of my core portfolio. So I put that 35% either in short-term bond funds or corporate bond funds. So that's how I do the 45% allocation to debt that I intend to do. Now, because I want to do 50% in equity, what I do is I keep 35% in my core portfolio, which can be large and mid funds or flexi cap funds. And I can take that slight risk by putting the remaining 15% in the satellite portfolio, where I can either do international investing or mid cap. And again, for moderate investors, in my opinion, gold allocation becomes a satellite investing, which is 5% in the satellite portfolio. So that's how I would bifurcate a moderate risk profile client's investment.
Okay, and finally, a conservative portfolio, Kirtan?
So, Sumera, in conservative, like we know that a larger allocation has to go to debt. So, because I want to do a 75% allocation to debt, right? But I want to further break it down into liquidity, core, and satellite. So, what I do is I put 10% in liquidity, which is either arbitrage or liquid funds. Now, I put the remaining 65% of my debt allocation in core. So, what I do is I can do money market funds there, corporate bond funds, or short-term debt funds there. The remaining 20% allocation that I really need to do to equity will here become a part of my satellite portfolio, because I'm not an aggressive investor. So I put 20% of my money in flexi cap funds. And over here, unlike in moderate and aggressive, the 5% allocation to gold that we are talking about is actually not a satellite portfolio, because we are not doing it to take slightly out of context risk. But here it's a core portfolio part. So gold 5% becomes a part of your core portfolio. So largely what we are saying is, Sumera, that while you break down this broader asset allocation strategy, try and have 10% in liquid, 70% in core, and 20% in satellite portfolio. That's how you do the bucketing.
Understood. Kirtan, this was very, very helpful. And I hope that retail investors have made a note of how to allocate according to your risk profile, and more importantly, stick with it. Kirtan, once again, thanks very much for joining in. We're out of time on MF Corner. The team of Closing Bell joins you next.